Hello everybody, welcome to TraderMerlin Show for your Wednesday edition. Yesterday at the end of the show, I asked you guys, hey, tell me about who you want to see in the program. And you were machine gunning off names, and the good news is I spent some time on the phone today and got some people on the program, which I probably should have done earlier because they're great content and good people to have on the show anyway. So we'll bring up our guest here in just a second. If you guys follow the Monday morning must-knows that we do for Online Trading Academy, you will have seen the comment I made about the FOMC meeting minutes. I actually posted on my Twitter feed today. I said, Jerome Powell's testimony or his rate statement is like a police account of a shooting. The FOMC meeting minutes is like the body camera footage of that shooting, and boy, it tells a very different picture, and that I think spooked the markets today. We saw some big downside moves, not just in the overall equity markets, but in the cryptocurrency markets as well, nosediving as soon as that announcement came out. So we'll talk a lot about that, but I want to get a sense of the big picture, look at the macro things, and we're going to talk about the January B.E.C.C report with Scott McCormick, CMT. Of course, B.E.C.C report stands for Bonds, Equities, Currencies, and Commodities, so it's a broad overview of everything that's going on. Welcome, everybody, Mr. Scott McCormick. Scott, how you doing?
Doing well. How are you?
I'm great, man. I love it. I'm having a good old time. I'm off to a good 2022. And
yeah, Happy New Year.
Happy New Year, right? It's funny because it used to be so much more exciting when you're younger. You know, you have the crazy blowout parties. Now it's just like a reset, and okay, I can now have another 365 days to measure performance of my accounts, and that's pretty much what I look forward to.
Pretty much.
It sounds so boring, but that's just the way it is.
You know, when New York had the ball drop
yeah.
at midnight, I live in Dallas, and so I'm an hour behind. And when that went down, I'm like, all right, cool. Happy New Year, everybody. Time for sleep.
Yeah, I'm surprised you made it that far, old man.
I know. It's sad.
All right, let's start us off. So obviously, you know, we'll sprinkle on some of the rhetoric talk track, which is about the FOMC and interest rates and inflation. But I want to talk about those four asset classes first. Let's get that out of the way and kind of see has anything changed on the landscape of bonds, equities, currencies, and commodities. And I guess we'll just start with bonds.
You know, it's funny that you bring up bonds because you know, this is one of the things that we always look at in the stock XLTs and comparing bonds to stocks, and we do this inside of the B.E.C.C report. You know, because for the most part, when you're looking at managing portfolios, you have to ultimately decide where it is that you're going to allocate your money, and of course, how much of that money is going to be allocated to each one of those asset classes, if any at all. And one of the things that I look at to help me in that process is referred to as relative strength. Many of your listeners have probably heard of it. But when we look at that chart, and it's a weekly chart of you know, comparing the AGG, which is the aggregate bond index ETF, and we're comparing that to the S&P 500 and using those as proxies for the bond and the stock market. Bonds have been underperforming stocks significantly since about second quarter of last year. So ultimately, like and I say last year, I really mean 2020. First quarter of 2020, when the equity market put in its bottom, you know, bonds pretty much put in a top a few months later, but their performance put in the top in the second quarter of 2020, whereas I think the AGG actually put in its top a little bit later. And so when looking at this, you know, bond market has pretty much been, I think, anticipating a lot of what's happening right now in a major way. And you know, I like your comparison of the Fed meeting minutes. And I always joke that if you have insomnia, you can download that from the Federal Reserve website and you can, you know, keep it on your nightstand. But you're right. I mean, it gives insight into their meetings. And what's really kind of shocking to me is that this has been the topic for years now.
Right.
You know, they've been looking for opportunities to really kind of reduce their balance sheet and to kind of back off on all of this money that they've thrown in the market. And I think to kind of use your New Year's Eve analogy or you know, topic here, it's almost as if though today the music stopped and somebody turned on the lights and everybody else realized, oh wait, the party is over.
Yeah.
You know. So that seemed to be the reaction this afternoon in the markets.
Well, it's kind of funny because what was said or what was released in those meeting minutes was pretty much in line with what Powell has already said. You know, it's like
Right.
Powell said these things in December, and markets were like, hey, let's rally 1.6%. And then the meeting minutes come out, it's like, oh, shit, let's tank. You know, it's kind of surprising to me. I guess it's maybe this perception that Jerome Powell is just one viewpoint, and maybe he didn't represent the whole committee, but then the committee comes out, and even the most dovish people are like, yeah, we probably need to raise rates sooner rather than later. And that was like, uh-oh, now we have a problem. And I love it because I've been saying this for a while. I think the problem is much bigger than the Fed is letting us believe.
Well, you know, it's there's probably some truth to that statement, and I always try to go back and look at it from their perspective, right? If they have a dual mandate as a central bank, which is full employment, and they also have, you know, the concerns about inflation and trying to keep that within certain parameters. You know, this morning we had a much larger than expected ADP figure, which might be a prelude to what we actually see on Friday morning. You know, the weekly jobless claims, these are reports that are coming out that are showing that, you know, they're like at all-time lows in terms of people filing for unemployment, even though you have millions of people leaving the job force. And so there's a lot of demand in the workforce right now. So, you know, I think their concern at this point is really not full labor, because you have employers clamoring for talent. And then in addition to that, you know, you're looking at the interest rate environment, right? So it just seems logical to me that the easiest thing for them to do at this stage is just start selling some of the bonds they actually have on the books to get the rates actually higher without actually affecting the Fed funds rate, which is that rate that, you know, these banks borrow at from an overnight standpoint. So what might be happening right now is just a bit of an adjustment to the realization that, oh, okay, yeah, they've been talking about this, but now it's actually happening. So maybe a little, I don't know, boy that cried wolf there syndrome for a lot of people. But, you know, ultimately, this is not the first time where the Fed has been hawkish on their monetary policy. It's just been a long time since they've really
been since 2009. I mean, it's like no need to raise rates. I mean, I actually have, what do I have up here for the viewers? I have the 10-year up, and, you know, we can go all the way back into 2009, and you can see even back in 2009 when rates were getting slashed down, the 10-year was still up around 3%. Just to kind of put that in perspective, you know, and right now, I don't know if you probably don't watch the show, Scott, but on my January kind of Outlook edition on Monday, I was saying, look, you know, I really think you'll see these bond yields continue to rise. The Fed's going to be forced to you know, taper and, of course, raise rates, which the short end of the yield curve rises. That could raise something like the 10-year as well. And, you know, you look at this, you've got an ascending triangle or a cup and handle, whichever way you want to look at it, on your 10-year. You know, 2.5% or 3% is not out of the realm of possibility for the next few months or even this year.
Yeah, I would completely agree with that. And if you go back to like 2018, I mean, interest rates went up for a while. We were up at about 3.5% in 2018. It wasn't. Nobody was really kind of freaking out at that point. I mean, we did see a bit of a market correction in the latter part of 2018, but it bottomed out about 2 months later. I think we topped out in October, and we literally bottomed out, I think, on like December 24th on the half-day session. You know, so I think, you know, what outside of the macroeconomic perspective, let's kind of like think about why they would actually do this. Sure, they need to reduce their balance sheet, because if they don't, we run the risk of having higher inflation. But the other part of that too is that we have to consider for a moment that they wouldn't take this away unless they had some degree of confidence that the economy can actually support itself at this point, right? Yep. You would have had much more dissension in those meeting minutes than what there actually was. So one of the things that I think I would encourage our listeners to do is kind of take today in stride and just understand that this is the initial reaction to the market. And a lot of times, in my experience, you know, when I first started off in the industry, it was back in 2000. And, you know, I remember being on the floor and everybody getting excited that, oh, the Fed cut rates. And it's like, okay, they cut rates, and the market would spike for a day, but then the market would continue to go down, especially during the time, you know, in 2001, 2002, when we were in the bear market. And then, you know, when we started to see rates go back up in like 2004, I noticed the opposite behavior. You know, they would raise the rates, the market would drop for a day or two, and the next thing you know, we're making another high, you know, a couple of days later. So it's very interesting to me how the markets kind of react to this initially, and I think it's important for the listeners to remember, be mindful of what your time frames are. If you're a day trader, I hope you killed it this afternoon.
Yes.
If you're more of a position trader, days like today might actually present an opportunity to enter in the direction of the overall weekly and monthly trends.
Is there a certain point, and I like your point is very valid. And I say it all the time. Even though we see these markets ripping to new highs, by raising rates, there's a belief that the party's over, and it's nowhere near that. It's just, if we go from 25 basis points on the short end of the yield curve, the Fed funds rate goes from 25 basis points to, let's say, 50 basis points. It's not like, oh my gosh, this is it, it's over.
Right.
But every incremental, it's like you put your foot on the brake pedal. You haven't really depressed it all. You just got it resting there. And I think the more that they press, so if we start to see the Fed funds rate get to 2% or 3% or 4%, then it's going to have a pretty substantial impact on the economy. But you're right. It'll have a knee-jerk reaction. This may just present a buying opportunity for those who still think we're going to higher highs, because money is still incredibly cheap right now.
Yeah, I'm very much in the camp of being a trend trader. I mean, if I had to describe myself, and the other, so the reason why I'm kind of bringing that up is because even though there's the prospect of higher highs, as I've alluded to, you also have to be mindful of the fact of where that level is in the market, where you have changed the structure of the market. You are no longer technically on or in an uptrend relative to the time frames that you're watching, right? So if you are a little bit longer term, there was a swing low that was put in on the S&P around 4506 on the cash index, but the major one is actually down around 4292. And so when you start to put things like that into perspective relative to where we are right now, the market itself could actually drop about, actually from where we closed today, almost another 8.7%, which would be about a 10.5% decline from this week's high. And, that's going to look pretty scary. But by the same token, it's not the first time that the S&P 500 has dropped 10%, and the next thing you know, about a month or two later, we're making more all-time highs.
Right.
I mean, that's kind of been its MO since the market broke out to all-time highs back in 2013.
And I'm drawing in the chart on here for you just so you guys can see what Scott was talking about. This red line represents that 10% pullback off the highs we established this week. And while it may look like, oh my goodness, it's a huge correction, just if you take a step back and look at the big picture, it's really nothing. I mean, it's honestly, as a trader, I think anybody who's traded for a long time will tell you, we've needed more of these types of corrections of 10%, right? It's just a natural pause for the market, whereas we've really only had one, right? Back in January of February of 2022. Other than that, we haven't had a significant pullback at all.
Yeah, I think going back to like September, October of 2020, there was that time when we went sideways, and I think from the high to the low, it was right around a 10% correction. But outside of that, this is, most of them have been anywhere between like 2.5% to 5%.
Right.
And the thing is that, the market participants, they pay attention to this, right? And they know that it's like, okay, well, if the typical pullback or sell off in the market is 2.5% or 5%, then I'm going to look to buy down in that area. So when the markets sell off that much, let me know. I'll make the decision then. They'll put together a game plan. I remember a client that I had back at Schwab, and in the first quarter of 2020, or not 2020, but 2008, he was like, call me when the S&P is 50% of its high in October of last year. Like, okay. And the market dipped a little bit lower than that, but ultimately, he had a game plan based on the amount of discount that he was looking in the equity markets, and everybody does that. Yep. It's just relative to your trading style. So I think it's really important to just have perspective, and I think flexibility, right, is the best description. And I'm always thinking of like interviews that I've listened to in the Market Wizards series, and if I'm not mistaken, inside of one of those interviews there was a title for it that was Strong Opinions Weakly Held. And the meaning of that, of course, is that you can have a very strong bias to one direction or another, but you have to be prepared to change that and recognize that as quickly as possible. Going and just to kind of give an example, going into these interviews and just kind of recalling some of these things, Paul Tudor Jones, back in 1987, during his interview, he was very bullish. But by the time that the crash took place there in 87, he had actually flipped short and nearly doubled the value of his fund. So you have to be very, very flexible and also be mindful of the environment that you're in, because with the change to their monetary policy, the winds are changing. It's a little bit different. And
it's not over yet. It's just slow. No. The writing just becomes ever so clear, much more clear with each passing meeting or announcement.
Yep. It kind of, living in Texas, we really don't get many seasons anymore. But, there's always that day in September where, the temperatures are a little bit cooler than what they had been. And you realize that, summer's over.
Right.
And today may have been one of those instances for a lot of participants.
Yeah. All right. So we've gone through some of the bond side of things. I think that you and I are both in agreement that we'll probably see rising rates going forward. Equity markets, we covered a little bit there. Let's go into currencies. Obviously, there's a ton going on in the currency. Anything that's really hot? I mean, we've been talking about the dollar on this program for a while, gaining strength. What are your take?
So what's funny is, and I apologize because I don't recall when I was on your program last. But
August.
Was it really?
It's August, yeah, man.
Goodness gracious. Well, happy belated birthday, Merry Christmas, and Happy New Year. How about that?
Well, thank you. I got all three of those in there.
Right. So if I'm not mistaken, going back into August, I was fairly bullish on the dollar index and still continue to be. I think it's important for your listeners to understand that whenever I look at charts, I'm always starting with a monthly chart. Unless I'm day trading, then I'll probably start with just a daily chart, and then I'll work from there. Maybe every once in a while I'll go up to a weekly chart, but I always start off with monthly charts to give me the right perspective, especially from a longer term standpoint. And so when I look at the dollar index, what I saw is that basically the dollar index has been in this bigger picture sideways range since about December 2016, January 2017. And the upper range of that is in and around $1.02, if you will, for the dollar index. And we're basically halfway in that range right now. Is it possible that the dollar could turn around and decline? Absolutely. It goes back to what I was saying just a moment ago, right? Strong opinions, weakly held. But consider for a moment that if we do enter into more of a committed rising rates environment, it's going to make our bonds more attractive relative to some other foreign countries, and that might actually put some positive momentum, if you will, behind our dollar index. So what's interesting to me, though, is that over the course of this past month, the dollar index has very much been inside of a very tight range between about 90, about 96, 97, let's call it 97 cents to 95 and a half. And until we get outside of that range, it's really, kind of questionable as to what's going to happen with some of the other big currencies. Yep. One thing that I have noticed here is that the Japanese yen. So if you're looking at the spot Forex market outright, it would be USD JPY. Has been, it's had an inverse correlation to the bond market, in particular the 10-year note. So if you are paying close attention to these things, it's important to understand that at this point. Market correlations aren't always there, but when they are, you should pay attention to them. And of course, with that, the inverse, which would just be the Japanese yen, is of course declining right now, going along with the 10-year Treasury. So if we have a possibility of interest rates continuing to climb, then we might see continued weakness inside of the Japanese yen, and for the dollar yen, potentially get back up to about $1.25 or even higher. So,
and for viewers, just so I can clarify, I've got the USD JPY. When he says weakness in the yen, that means that this chart would continue to move up because this is the dollar against the yen. So that basically means that the yen is falling and the dollar is gaining strength. So you can see that the dollar is especially over the past couple of weeks, I'll call it a month, has just really been on a tear to the upside against that Japanese yen. So if you want to go to Japan for vacation, you'll buy yourself a lot more ramen right now.
Right? Yeah, and I've got a projection on the dollar yen at 150.
Oh, 150.
So, yeah. Now, keep in mind that is a multi-year projection. I mean, that's not something that I would expect to see over the course of next week. But whenever I'm looking at these monthly charts, I'm paying attention to the longer-term cycles as well as the short-term cycles and trying to figure out where we at relative to those things. And when you consider for a moment that the price action in 2015 going through to mid 2016 was corrective relative to that impulsive phase from 2011 up to 2016, 2015, that suggests that if what we are seeing right now, and if we break out above that 118 area, we're probably going to see more of an impulsive state again from a longer term perspective, and actually see that 150 area, which would coincide again with some interest rates moving much higher in the bond market. And so, again, keeping a close eye on those things would be prudent.
Scott, let me ask you this. That's a pretty lofty goal, but if we get there, hey, it is what it is, right? Who cares?
Right. You've heard it for your first.
Yeah, your first. From a macroeconomics perspective and from an economy perspective, if the U.S., if the dollar got up to those levels against the yen, doesn't that start to hurt the U.S. economy? Wouldn't you start to see, as a guide, to me, if it gets to the 130s, I think you'll already see politicians jumping in and going, hey, wait a minute, we should probably do something here, because at that point, goods and services produced by the U.S. are going to become extremely expensive for foreigners, in this case, the Japanese. But I'm assuming that dollar would be rising against many other countries, the euro, the pound as well. At what point do you think that a government's going to come in and say, we have to weaken our currency because you just can't keep letting it rally like this?
Yeah, I mean, it wouldn't be the first time that a country has intervened for those reasons. And, unfortunately, that aspect of macroeconomics, that is beyond me. That's something for the politicians and the Treasury to decide. I'm just looking at the charts and telling you what I see.
Yeah.
And so there's always going to be a risk of something like that happening. And a lot of the times you're going to hear some chatter. But I'm trying to measure my statement here. A central bank or a foreign government is not necessarily going to come out and tell you exactly when they're going to do something, especially intervening in their currency. However, sometimes you start to see the price action first because, there are some people out there that've got their ear to the ground and, they hear some stuff. So keep an eye on the charts.
Yes, definitely. I mean, it's funny because we look at a lot of different ones here. You guys, really the dollar is, to me, where you want to be parking your money at least for the foreseeable future. You can see here the USD JPY has been on a great trend. You've got USD CAD is actually not on a great trend. Again, this is on a monthly. I guess I could drop this back and go into something like a weekly, give us a little bit clearer picture. It has certainly been moving up, but for the last year and a half, 2 years, it has been decisively down here on the USD CAD. So the Canadians, David and others out there, good job for the Canadian dollar. For the euro, the euro still just tanking against the USD. So no surprise there as the dollar's been gaining strength. For the Aussies, same picture. And for the British pound, a similar picture of weakness for the pound, but there's been a little bit of a bounce in the past month or so on the British pound against the US dollar. So I just wanted to show the rest of them.
Yeah, and kind of circling back there to the Canadian dollar and to the Australian dollar, obviously very, very heavy commodity-based economies. And so one of the things that your listeners should really kind of pay attention to would be the commodity index. Watch very closely metal prices, copper, gold, silver, crude oil prices, obviously, for Canada. But I was looking at this last week. We did a year-end wrap-up for our strategic investor group, and we were taking a look at the Thomson Reuters Commodity Research Bureau Index, which tends to be more of a balanced index for the commodities. Because some indexes out there, they're a little bit more weighted towards either grains or metals or energy, so they're not quite balanced. So on TradingView, there's a ticker symbol on that is T as in Thomas, R as in Romeo, J as in Juliet, E as in Echo, F as in Foxtrot, F as in Foxtrot, C as in Charlie, R as in Romeo, B as in Bravo. And one of the things that you'll note
that's I have to say real quick, that is the worst ticker symbol I've ever heard of in my life.
I know.
Like, like NASDAQ, you're like NASDAQ's 4 or 5 letters. The Dow is 1, 2, maybe 3. And here you have 1, 2, 3, 4, 5, 6, 7, 8, 9 symbols in that. Goodness gracious. Anyway.
Yeah, it's a pretty interesting symbol. Unfortunately, I used to have that on TradeStation, and I simply can't find it anymore. So I was fortunate enough to find it on TradingView, because it gives us a chart going back to like 1995, which is, in the grand scheme of things, that's a pretty long-term chart. But one of the things that I pointed out in our meeting is that the commodity index itself has actually broken its long-term downtrend that began, with its market top back in 2008. So we do have the termination of that prior downtrend. With that, we might actually start to see higher commodity prices across the board, which would, of course, be coincidental with the inflationary environment that we're in. The other thing here that I'm going to be paying very close attention to, though, is the relative strength of commodities versus stocks, which is yet to turn higher. But the reason why that would be important to me is because from a longer term perspective, looking at an asset class rotation, commodities tend to be the leading group as you are moving in towards a market top. Okay, so kind of think like the 2007, 2008 timeframe. Back in even before then, commodities were leading during most of like 04, 05. In 06 they had a bit of a decline, but going into 07, again showing some strength. And so with that, when we see the combination of all of these different factors, right? So raising rates, bond prices are declining. We start to see commodity prices outperforming stocks and bonds. That's more indicative of a market top. And we're not quite there yet, but again, we're starting to see some of these shifts from a longer term perspective. I always kind of chuckle when I hear, talking heads on TV get really bearish on the markets over the course of the last 10 years or so, because there's not really been a lot of evidence to suggest that this party is over yet. However, we're starting to see some of the signs now. Small caps are underperforming large caps, which is not the first time that's happened over the course of the last 10 years. We're also now seeing commodity prices do well. We're finally in an environment where we're starting to see some serious concern about interest rates, right? Again, going back to the early part of this conversation, it's not the first time, but when you start to get more of these elements lining up, that's when your attention should really be focused on these potential shifts and being prepared and having a game plan.
There's obviously different ways we could play that, and Margaret says, does that mean like buy DBC or DBA? Go look for some of these commodity ETFs.
You could look at some of the commodity-based ETFs. What I would suggest, though, is that as you do that, one, if they are leveraged, look at how they are structured and how much they have in assets underneath management. Because if for some reason commodity prices did just break down, and these things are being most likely backed by futures prices, you could see some serious trouble, right? We saw a couple of years ago a run on a VIX ETF, and the value of it declined almost 70% overnight. I think it was actually maybe a little bit more than that. So you do have to be careful about the type of ETFs that you select, but in general, the strategy of having long exposure to commodities would be prudent. So some of the ways to do that, of course, we mentioned the Canadian dollar and the Australian dollar earlier, but you could also look for exposure to those countries' stock exchanges or stock indexes through the EWC and the EWA. You might also want to take a look at Brazil. That would be EWZ. But if you are looking for more stock-specific plays, you would have to start digging in a little bit deeper and going into the metals and the energy stocks to get direct exposure to those areas as opposed to just using the ETFs outright.
Love it. Last one. Let's talk about oil. I know that obviously in the commodity space, this is a critical one. I'm trying to. I had my oil here. Where the heck did I put my oil? Where's my oil chart?
It slipped away from you?
No, it never does. There it is. It's the first one on the list. There's my crude oil, and obviously the chart here has been looking great. It's been stair-stepping higher, and higher highs, higher lows, kind of trending the upside. Is there a long-term prognosis for you on crude oil?
Yeah, so you and I have talked about crude oil before, and I pointed out a while ago that this thing is still in a long-term downtrend, but until it gets out above that prior high there at about 77, we have to kind of be prepared for a bit of a downturn. Well, not only did it break its downtrend line going back into the first quarter of this past year, 2021. We have now seen a close above that prior high in 2018, indicating that, yes, we have a termination of that prior long-term downtrend, and we've managed to put in some higher lows and higher highs on crude oil itself. So when we start to take a look at some of the longer-term projections and where this thing can go in the short term, it's probably going to be up and around $100. Whether or not we actually get back up to like that 130 to 140 area that we were back in or at back in 2007, 2008, that's yet to be seen. There was a statement the other day that OPEC is going to continue to, provide or continue to increase their supply for crude oil. However, that's one element to it. What the big question, of course, would be what's the demand side look like? When we go through the process of considering for a moment that although the economy is not where it was back in the first quarter of 2020, it's also not where it was before we started. So we're better than where we were, but we're not quite where we were when we were kind of firing on all cylinders. And so when you start to look at things kind of returning back to normal, if and when that happens, I'm just going to say when, not if, because I'm sure it will. It's just a matter of time. The question is going to be, what does that global demand actually look like for crude oil? And I'm sure it's going to be higher than where it is today.
You're not in the camp of these people who are saying, "Oh, electric vehicles, crude oil is going to go to zero. It's going to disappear altogether."
Well, eventually that's probably going to be true, to an extent. And I don't know that it would go to zero.
Not in our lifetime, buddy.
Well, except for that one day in April of 2020.
Yeah, negative $41.
Right. But, because there's always probably going to be a commercial use for it. It's probably not going to be where it is today or where it was, 15 years ago. But, the fact of the matter is that there are some very smart people out there that will control the supply of that market. And so long as there's still demand, we might actually see some higher prices, I agree. I can't rule that out. Now, with the continued growth of the electric vehicle industry, yeah, I'm probably going to become a little less bullish on it longer term, but it doesn't mean that it can't go up over the course of the next year or two, right? In 20 years, who knows?
Right. Yeah, I think we'll definitely see a shift, and I think it presents opportunity for us because you look at fossil fuels and you're like, okay, well, we'll use obviously crude oil for petrol cars and things like that. But then all of a sudden you're looking at lithium and nickel and all these different rare earth elements that may be needed. And that's kind of the quote unquote fuel for the future of vehicles. So it just gives us an opportunity to shift from one commodity to another and have opportunities there. So bring it on.
Yep.
All right. Question from Mark. He says, how are the U.S. markets going to be affected if the Chinese market continues to have problems, or will it have an effect at all? You got any take on how China is going to impact us?
I'd like to know what problems he's referring to. I mean, there's the thing is that there's always going to be issues out there. If you're talking about, an Omicron shutdown or something of that nature, we're still
looking at chips and supply chain disruptions and things like that.
Yeah.
But it's getting a little better.
It's getting a little bit better. What's interesting is that yesterday's sell-off, a lot of that was due to chips, but you can't take away computers. They're always going to be there. The supply chain issues are going to eventually fix themselves. Whether or not that actually happens here within the next year, I think is yet to be seen. But I try not to focus too much on thinking about those types of situations, right? And the reason why is because if let me kind of restate this, because I say I don't think about these things, but I might be aware of them at a subconscious level, but I don't try to come up with some sort of a model that if China does X, then the U.S. is going to do Y. Right. What I do is I look at the chart and I say, China is doing X, the U.S. is doing Y. Do we have an X plus 1 or an X minus 1 now? Do we have a Y plus 1 or a Y minus 1 now? Right? And so I pay attention to the charts to try and tell me, okay, this is the shift that's happening, so I have to go with that. Mm-hmm. And I think part of the reason why this has really kind of been ingrained in me over the last 20 years is because I've seen too many instances where individuals will have biases or ideas about what will happen in a market or what should happen in a market, and it doesn't come to fruition, and they end up frozen, or worse, they end up fighting a market, right? I mean, I had a client back in the day who was at certain situations where they believe that there would be a shutdown of the Strait of Hormuz during 2008, 2007. There would be some sort of conflict with Iran. That never came to fruition. Yet the portfolio was positioned in a way for that to actually happen. And, there's just missed opportunity as a result. Yeah. And so, when you're looking at these markets, right, one of the things that, again, I constantly do is I'm looking at comparisons of different asset classes. And so for me in particular, I'll look at, let's say, the EFA, which is the developed countries. So China wouldn't necessarily be included in that, even though they're like the second largest economy in the world. But I compare international to domestic stocks all the time. And one of the things that's very interesting to me is that, international stocks have been underperforming domestic stocks since 2008. So I'm not really concerned about having a lot of exposure there because I know where the performance is. The performance is in U.S. stocks. Mm-hmm. Now, if I start to see a shift in that ratio, then that's going to be my canary in the coal mine that says, hey, there are some things that are shifting here, okay, and would force me to start looking at opportunities overseas, which may or may not be in China.
Right. Yeah, and a lot of people are so concerned about China's debt. Last thing I remember was like 270% of GDP. The U.S. was running roughly 140, so obviously almost twice as bad as the U.S. But mm-hmm. Part of the problem I have with these economic data points is, and no offense to anybody in the audience who might be Chinese, but I don't trust any data that comes out of China. I just don't trust the numbers. Of course, I'm hypocritical because here I am in America, and who knows if our numbers are even remotely close. Obviously, they're probably painting a rosier picture. But, the fact that their debt to GDP is stated at being almost 300%, yeah, that does pose a little bit of a problem. And if they go into some sort of default, then obviously that creates issues. But as a trader, I'm not so concerned with that. I mean, that's a long-term investor thing. I'm a little bit more active than that, but I guess it depends on our time frame and how long we're in the markets till that stuff really impacts us.
Yeah, I mean, I think if you own bonds outright in China, or if you had direct investment in China somehow, then yeah, you probably have some cause for concern, and you would want to make sure that you have some way of hedging yourself. But most retail investors here in the U.S. don't have that. Right. So it might not be of a concern for you. Now, the concern would be, let's say, for instance, you are the retail investor, but there is an institution that you have access to that is doing the foreign investment for you. Then you would want to make sure that they have a process in place to protect that fund. And if not, you need to be diversified in a way to where maybe that fund only represents 5 or 10%. And even if they did take, 100% loss, you're only risking 10% of your overall portfolio, if that makes sense.
Yeah, absolutely. All right, we could go on for hours, but I got to wrap things up here. Tell me about your upcoming schedule. I know that I'll just do a gratuitous plug for anybody here who's an Online Trading Academy graduate. Scott McCormick, Darren Komodo, Jordan Matthews, Larry Jacobson, Gregory Theonis, and myself are doing a symposium next Wednesday. I think that's like from 8 o'clock until 1:30, so we'll be going over a whole bunch of different asset classes. I'll be talking crypto and whatever panel discussions I can get in there, but that'll be a fun one. What else is your schedule like? Where can anybody find you and take classes with you?
So, I have a very interesting schedule now because when I first started, I was pretty much just devoted to teaching classes in person at various locations around the U.S. Now, most of my time is really kind of dedicated towards the mastermind services. And so that includes working on the mastermind grid. It includes writing the daily market overview. But on a day-to-day basis, with the exception of those days where we might have a freak winter storm here in the Dallas area and lose power for a couple of days, I am every morning on the guided pathway sessions. And so I go through and do a market overview every morning at more of a macro level, but maybe not quite as macro of what we've been talking about here today. But then I pass the microphone off to the second instructor who takes it into a little bit more of a micro perspective. And so that's where most of our students will find me on a day-to-day basis, Monday through Friday. I will teach the occasional stock class. We've got one coming up in February. So if anybody out there is interested, just contact your local centers and they'll look into it for you.
Awesome. Well, hey, I'm glad we could get you back on the program. I was trying to get you on every month, but I don't know what happened, and we missed you in September, October, November, December. We started off the year strong, got you in the first week, so I appreciate you coming on today, Scott. Really means a lot.
I definitely appreciate you reaching out, so thank you.
Yeah, no problem. So I will see you on Wednesday, my friend.
Yep. Have a great week.
Great. Thank you.
Take
Guys,
care.
That was Scott McCormick, giving us some insights into the Beck Report, bonds, equities, currencies, and commodities. A ton of information there, and I think what I love about Scott is he's not being swayed by Powell's testimony or the FOMC meeting minutes or this, that, the other thing. It's saying, what are the combination of bonds, equities, currencies, and commodities? What are they telling me about the markets going forward? So it was interesting. It did sound like his tone has changed. Last year it was decisively bullish, right? There was really nothing that showed any quote-unquote chinks in the armor. There was no problems. Now all of a sudden it sounded like, just from what I gleaned from the conversation, that there is concern about rising bond rates. There's concern about markets possibly stalling out, which doesn't mean that he's bearish. It just means that his alerts have been triggered saying, hey, things have slowed down and we may potentially start to see things drift down. Awesome. Take it for what it's worth, but there's a lot of opportunity in every one of those asset classes we just mentioned, from bonds, equities, currencies, and commodities. And to me, love having him on. I agree with Big Ab. He's a sharp guy. He's just, he's a geek, and I say that with all the love for Scott in the world, because he's a geek like for the financial markets like I am. He's gotten a bit deeper with a CMT, which is a chartered market technician, which is a very elite group of people who have taken this test and passed all these tests to say that they are a chartered market technician, which I think is pretty cool. All right. What else we got here? You guys are hilarious. Oh, I don't know if you guys have ever seen it. There was a, Mark, you triggered this one, but there was a, you can pull it up on YouTube. There was a plane that crashed in San Francisco. It landed at San Francisco or Oakland. I think it was San Francisco, but it landed and the landing gear broke and it skidded on the runway. And somebody was like, screw it, this is my last day at work. So they wrote on the teleprompter for KTVU News all the names of the pilots. And I won't read it here because someone will say I'm being insensitive, but you can go to YouTube and check it out. They wrote on the teleprompter, and the announcer, the host of the news program, is reading these 5 names of the pilots, and you're just going to be holding your head in your hands going, oh my goodness, this is, I can't, anyway. It goes right back to what Mark was posting in there about No Trust China. All right. So will it be recorded? I believe so. I don't know. I actually went and looked in my OTA to see where that thing was posted, but right now all I know is I'm going to be doing a segment for an hour in that, so we'll see how that one goes. Scott will be there as well. As he mentioned, he does Mastermind Grid, daily market overview, which is awesome. Kind of sets you up for what's going on for the day from a level perspective and macroeconomics. So pretty good stuff from Scott McCormick. I'd love to see him out teaching more because you got him behind that little wall there. Let's get Scott out. All right, let me show you economic calendar here, and then we'll wrap up for the day. Here's your earnings calendar for tomorrow. Cronus has been on this list every week for the past month and a half. So don't think they're reporting earnings tomorrow, but they're on the list. Constellation Brands, one of the regrets I have is I did not buy STZ. I'm kicking myself for it because this is one that I've been bullish on for a long time. They've got Modelo. You got Modelo in your portfolio of products. I'm a fan. They got Walgreens Boots Alliance. You got Bed Bath & Beyond tomorrow, Lamb Weston, ConAgra Brands, Helen of Troy, and Schnitzer Steel reporting earnings tomorrow. Now, you notice all of those are BMO, which is before market open. That's mainly because these are mostly New York Stock Exchange ones, but usually the New York reports before market open. NASDAQ usually reports afterwards. And that's your earnings calendar. Economic calendar is interesting. There's quite a bit of stuff happening for the U.S. tomorrow. As Scott mentioned, you had that ADP non-farm employment change, which really did post some pretty impressive numbers, right? You had 807,000 new jobs created when they were expecting it to drop from 505 to 405. We doubled it. I mean, that's really impressive. But of course, the FOMC meeting minutes derailed all of that very quickly. You'll notice here we do have unemployment claims, which the fact it's under 200,000 is great. That's historical norm is right around 200,000, so it's below that. Trade balance, ISM services PMI, factory orders, and natural gas for anybody who's trading the UNG or natural gas. It's been a wild riding. Let me see if I can bring that one up for you because natural gas has been wild lately. Here is the natural gas chart, and you can see just monster swings out here in natural gas. Crazy moves in commodities. Then what else do we have to wrap it up? We have, for Japan, you've got household spending and CPI numbers. And then for the euro, you've got some trade balance numbers for Germany as well as industrial production. And that will be it. Now, as Margaret says, who are the guests on your schedule? So I have Mike McMahon for tomorrow. Mike McMahon is a longtime friend of mine. I used to work with Online Trading Academy. Now he's just a trader and a retired trader. And then next Monday, I'm going to have, who is going to be on the program? Jeff Manson. I'm actually working on getting Sam Evans on the program and several others of the names that you have mentioned. Maybe get Bill Addis on the program again, right? It's funny because a lot of people look at what Bill Addis talks about and they go, oh, bonds, it's so boring. But man, that guy has such an in-depth knowledge of the bond market. He's probably the only person in my 20 plus years of trading and investing who has actually made bonds interesting to me. They've always just been stupid to me. Like, why would I want to buy something and maybe get 3% interest when I can go to an equity market and maybe get 3% in a month versus 3% in a year? It doesn't make sense. But there's an interesting dynamic between how the bond markets move the world and how all of these monetary instruments, whether it's currencies or bonds or equities or even futures or derivative markets, start to influence everything, make up that quote-unquote watch piece I've talked about so many times on the show. Yes, I'll try to get him on once a month. He's actually one of the few people that calls me and goes, hey, I got some stuff to talk about. You got any time? Come on in, bud. Let's do it. All right, that's it for today. We are at another 15-minute show. I told myself this year I'm going to cut back to 30 minutes. I just can't do it. So you guys are like my heroin. You're my addiction. I just can't give up. So for tomorrow, I've got Mike McMahon on the program. His topic was kind of interesting. He says, the topic was going to be markets. Standing on the edge of the cliff will be the topic for tomorrow. So I'm curious to get his insights in it. He was talking about a few things that he thought looked very, very bearish for the markets. So let's see what Mike has to say about it, see how he's positioning himself for that. If you guys have any questions you want to ask Mike McMahon on the show tomorrow, you can send them in now. The sooner you send them in, the more I can get graphics in there. And then, of course, I have Russian spammers sending you guys porn in the chat, so we'll remove them. Bye-bye. Anyway, if you have questions for Mike McMahon, send them to TraderMerlin@gmail.com or for me, anything you want me to cover on tomorrow's show or future guests or anything like that. So thank you guys for enlightening Scott McCormick and myself today. Hopefully you learned some stuff about bonds, equities, currencies, and commodities, and I will see you all mañana. Take care.